Welcome to the From Lab to Patient, Garage to Market podcast with your host, Phil Crowley. In each episode, we will discuss professionals serving the tech startup market and the various issues of importance to those companies. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, CrowleyLawLLC.com. Now here's the host of From Lab to Patient, Garage to Market, Phil Crowley.
Welcome, and thanks for tuning into our podcast. You know, we focus on bringing you people with valuable insights into the life sciences and technology businesses, startups, and things that are related to them so that you can employ those in driving your business to success and avoiding avoidable errors. Today, I'm pleased to have as my guest Andrew Maxon, who is a partner and co-founder in Intellect Business Advisory, business valuation and advisory, and who is involved in the valuation of privately held businesses, which should be of great interest to our audience of entrepreneurs. At the end of our discussion, I'll ask Andrew to give you several tips, recommendations, things that you can use to choose the right valuation expert for you and for your business. Andrew, welcome.
Phil, how are you doing? Thank you very much for having me here today. Pleasure to be here, and very much looking forward to our discussion to come.
Super. Well, can you tell us a little bit about Intellect and what inspired you to choose this particular path in the financial services industry?
Yeah, fantastic. Thanks, Phil. So effectively, it's very just briefly on the background for me, which sort of led me into this. So started off at UBS in wealth management, so had a really good understanding there of asset allocation. I think working in wealth management is a fantastic background to understand holistically for the business owner, all of their investments, and then often the business, the privately held business, is the crown and the jewel or the key asset, right? So I had some time there. I then had another entrepreneurial endeavor in the tourism industry, which I think we might touch on later, and then ultimately co-founded this company about 6 years ago now, Intellect Business Valuations and Advisory. Now, when we first started, we were a little bit broader than we are today in terms of what we did. And then effectively at the start, we sort of offered more rather than less services, but then very quickly saw a real niche or demand for high quality business valuations or appraisals. In particular, that's something that we saw a lot of growth in or a lot of demand during COVID to be executed in a fully digital fashion. And we didn't see a lot of our peers or competitors that were actually doing that, let alone doing that quite well. So I'll touch on later a little bit around, what a good quality business valuation involves, and in particular for us, as independent valuers. So of course, it would be fantastic if you could go to an independent valuer and they give you a number that is more in your favour. That's not how we do things. We're very independent. Typically speaking, a lot of the time, the situations that we value for, of course, one party wants a higher number, the other party wants a lower number. So our job is to, effectively come up with those valuations, explain it in a defensible fashion, but also explain it to business owners in common English as well. So we saw a real gap in the market, to provide this and effectively just provide a professional, high quality service, to privately held business owners.
Well, I think that there's a great value in your service, even if the parties don't ultimately accept what the valuation is by the professional evaluator, because it provides sort of a peg that people can look at and try to rationalize rather than just saying, well, the value is whatever a willing buyer and a willing seller can agree upon. And I think that it helps a great deal. I'm very familiar with this in the pharmaceutical area where discounted cash flows are frequently used in order to assess the value of the company or the value of a particular product. And it seems that your services are extremely valuable for people who are trying to market their companies or to get an assessment of what the value of a company that could be a target of an
Absolutely.
acquisition could be. But there are also tax issues that come up in this, and Section 409A of the Internal Revenue Code requires that the companies value their stock at an appropriate level to get certain tax benefits. How do you deal with those sorts of issues when you're doing a valuation for instance, a United States company?
Yeah, certainly. We see, demand, Phil, to your point there, more holistically for the bucket that we refer to as compliance, right? So it's valuations for compliance purposes or appraisals for compliance purposes. And for those listeners that don't know, I'll use the word valuation and then appraisal interchangeably today as well. Now, we see demand for compliance purposes making up about 40% of our total workflow. So that's where the business owner, the management team needs to comply, to your point there, Phil, in this case with IRC 409A. And there's many other compliance purposes such as gift and estate tax as well. But specific, for your listeners, and in particular, entrepreneurs or companies that are experiencing high growth, and we'll be looking at, issuing options or something along those lines to employees. This is certainly what we're looking at. So effectively, without going into the details, of from a technical standpoint around the Internal Revenue Code, what it says is that options need to be issued at or above fair market value. So what that means from our side is we need to come up with the value of the company under fair market value. Now, there's a few interesting things to consider there, and that is that typically what we see is that companies that are required to comply with IRC 409A, often they're raising capital. They are these high growth companies. It might be high growth tech companies. It might be high growth biotech, something along those lines. Now, often where they raise capital at, there's a thing in valuation called a standard or basis of value. And effectively, the IRS, for most of their, if not all of their valuation purposes or reasons you need to produce a valuation for them, the standard of value there is fair market value. Now, where businesses often raise capital, it's often at a higher standard of value, which is called investment value, which is a value that's available to a specific buyer. And effectively, that's a value to them. And that's often because they're a strategic player in an industry, or they can access synergies by investing in that company or possibly buying that company one day. Now, that's very different, and you touched on it before, Phil, than fair market value, where the definition of fair market value itself says it's a willing, but most importantly for me, a hypothetical buyer and seller. So it's not one specific investor, it's not one specific key player. It could be anyone in the market effectively. So because of this, we see situations, to run through a basic example, where you might have a fair market value. Let's keep the numbers simple. You might have a fair market value of $10 million for the business, but then you might see them actually raising capital under an investment value at maybe 15 million or 20, sometimes it might be 30 or 40. So that can be materially higher. So that's one of the first pitfalls that we see companies, effectively doing. If they don't get an independent external appraisal, often they will use the valuation, the implied valuation from their last raise as the value that they use on their paperwork effectively for the fair market value to issue options ahead. And often that can mean it's materially above the actual fair market value of the common stock and thus the options that they're issuing. So certainly considerations there, yeah.
A real disadvantage to company employees and particularly the management team if they just blindly go ahead and take the valuation that they are using for investor purposes. And if I understand you correctly, that valuation can be far above what would be a realistic fair market value. So I think that's one very good recommendation for our entrepreneurs to keep in mind, that a valuation expert like you can justify a lower valuation for the purposes of issuing restricted stock and stock options, and still not impair the investment value that the team is seeking to acquire by having outside investors invest in the company.
Absolutely. And I think you've nailed it there, Phil. It also, for us in those situations, really comes down to education and explaining this, right? Even the concept of a standard or basis of value itself, it often takes me a long time to walk through with a business owner and explain those differences. People just go, it's very common as well, business owners or participants in the market, often they'll go, oh, I think the valuation of asset X, or business Y is this. The first question I'll say back to them is, often what standard of value are we talking here? And they have no idea. They just think there's one value, but there's actually multiple standards of value. So I think of that as sometimes an annoying almost definition or legal term, right? But it is a reality. So having a good understanding of that and understanding that for compliance purposes, to your point, Phil, you can do things at fair market value, which this is not the same for all industries, right? But for most of your listeners here, assuming they are in industries that are high growth, often it is a situation where you can do things for a compliance purpose. May it be complying with 409A or say gift and estate tax if you're looking to minimise, federal estate tax. You can operate and do things at a fair market value level, which is materially lower than where you may raise capital or hopefully one day actually sell the business. So managing that right, but also to your point there, understanding the difference between the two so you can reconcile and explain that to your key employees or your investors, whichever stakeholder. That's really, really important because something that we will see other times, to my prior example earlier, if we say that the fair market value was 10 million, but then they're raising capital under an investment value of say 20 million, obviously people want to understand the difference. Why is there such a big gap? It makes no sense, right? So it does make sense. And that's something that we explain in the valuation process, but ultimately it takes a lot of time to understand why it makes sense.
Well, I think that's
And once,
particularly, I'm sorry, Andrew.
no, go
I
on,
wanted
yeah.
to point out that that's particularly relevant in the area of biotech, where small companies have really great ideas and can quickly take them to proof of concept and get them to the point of having human clinical trials. And then they may be purchased by a large biotech or a large pharmaceutical player for whom having that product can be tremendously beneficial. And it's like putting a coin into a big machine. You drop it in, and you have sales, marketing, operations, regulatory affairs, and they know how to do all those things. And all you have to do is feed them the new products,
Yeah.
and they can go to town with that. And so, I've frequently had this discussion with my clients with respect to the difference between a financial investor, like a venture capitalist who's looking for a financial return, and a strategic investor who's looking not only for a financial return, but even more so for products to fill the pipeline. And so being able to distinguish fair market value from the value for investor or the value for a strategic partner, it seems to me, can be very valuable to the team in terms of setting appropriate levels for the issuance of equity compensation at reasonable levels so that you give employees and particularly the team members an opportunity to profit from the further growth and development of the company.
Absolutely. Couldn't agree more. And you've touched on it there, the risk ultimately, in particular, if you're issuing options or stock in future, right? Privately held business. If you get those levels wrong, it's too high or it's too low, someone is losing or someone is winning, right? The last thing you want is disgruntled employees that are key to your operation in your business. So ensuring that you get those valuations right, where future stock or options are issued relative to older ones, are really, really important. I think another pitfall we see there, it's one thing to do the exercise and have that understanding, but again, most importantly as well, is just to explain it to your employees. They need to feel comfortable. They need to understand it and feel like they are incentivized, to your point, and they've got a good deal. Because if they don't, obviously that lowers their motivation to achieve the company's goals and objectives and help you as the owner, right? So really, really, really key.
What have been some of the most interesting valuations that you've been called upon to opine on?
I think it's typically driven by the purpose or the situation. So again, there's another thing in terms of definitions within valuation or appraisals, and it's the valuation purpose, or in common English, it's what is the use of the valuation? Why are we even getting the valuation, right? And that naturally flows to who is the intended user or the audience of the valuation.
Mhm.
Now, the reason that I say this one from a pure interest standpoint, often, unfortunately, it's when it's involving litigation. So I think, the classic two are where we're valuing a privately held business as part of a divorce, unfortunately, or valuing a privately held business as part of shareholders separating under not such good terms. Now, in either of those situations, assuming it is hostile, you've got parties in a situation where often parties are not communicating well, and one side wants higher numbers and the other side wants lower numbers. Sometimes you also have situations where one side will have access to complete full information and the other side will have access to none. So if you'll think about again a divorce where effectively one of the two partners works in the business full time, the other one is never has never worked in the business, right? That the value of that business needs to be identified for the separation or the settlement of those partners, and one of them understands the business inside and out really well. The other one really has no idea and has no access to information either. So
Right.
we can be engaged collectively. We can also be engaged by either side. In any case, you get a situation here where ultimately, one side is telling a story how the company is going to list on the Nasdaq next week, next year. It's going to IPO. It's going to the moon. And go and figure, the other side is saying, "Oh no, it's going into bankruptcy next week. We're running out of money. There's 0% chance of that." One side gives you great information, the other side gives you none. And then effectively, we need to come up with and obviously ask the right questions as well,
Right.
but effectively try and come up with a reliable, defensible valuation despite having two information sets, ultimately telling you two completely different things.
Oh, yeah.
So certainly that those situations and those valuation purposes can be challenging, but I think, as a company and for me personally, challenging means interesting to your original question.
Well, that's good. Well, let me take just a brief break here, Andrew, to introduce Crowley Law. I'd just like to help people understand that our firm is passionate about helping growing life sciences and other technology entrepreneurs realize their dreams, to take great ideas from the laboratory bench to the patient's bedside, or from the garage to the marketplace to enrich the lives of thousands or even millions of people. I'm a former research physicist who decided he needed to see some more direct application of his work to helping people. And so I chose a career in law. But as a physicist, I understand how hard it is for you entrepreneurs to go out and discover new knowledge and to make technology work. And as a lawyer, I understand how difficult it is to take that new technology and bring it successfully to the marketplace. So I and my associates are really focused on helping founders realize the value of all that hard work. I invite you to go out to our website, crowleylawllc.com. We've got a host of resources for you to use for free, and would love to have the opportunity to have a chat with you and to learn about the things that are keeping you up at night, because we're here to help. Thank you. Andrew, let's get back to studying and discussing some of your entrepreneurial efforts, because not only are you a business valuator, but you've taken your hand at starting and running a business in the tourism industry. I thought that was really fascinating because you not only talk the talk, but you have kind of walked the walk of the entrepreneur. Tell us a little bit about how you got involved in that.
Yeah, fantastic. Thanks for the question, Phil. It's certainly an interesting background. I touched on it a little bit at the start, and ultimately, I worked in corporate, if you will, for Swiss Bank UBS until 2016. Then embarked on what is one of my major passions in life, which was some travel. I've always loved travel. Your listeners might be able to tell I've got a funny accent, so I'm from Australia originally. So I've always done a lot of travel. I've always been fascinated, obviously, with the US, which is, our primary market, right? And effectively, before embarking on Intellect Business Valuations and setting that up, I started doing some travel through Central and Latin America. So this is at the end of 2016. Now, Phil, that was meant to be travel for about 1 month. And then effectively I was going to move to New York or London, get back into some form of, corporate finance, may it be wealth management or something else, right? And ultimately a month of travel turned into a year of travel, in which time I started to learn Spanish as well. I was enjoying, attempting, shall we call it, to pick up a second language, which is certainly not so common in Australia. And ultimately, then around halfway through that year, I decided, well, I don't want to get back into the corporate world yet. And I would rather, go down the entrepreneurial path, do something for myself. And then I started to think, well, in what do I have a lot of expertise and know a lot about? And at that point, I thought, well, it's probably a little bit too early for me to set up, a wealth management firm, given the complexities of doing so. So beyond that, my expertise was definitely in travel. So I then moved to Medellin in Colombia and ended up purchasing a hostel that I actually stayed in as a tourist a few months prior when traveling through. So it was my first go at entrepreneurial life. It was, I was looking for obviously a good financial and economic return, but at the same time, it was also a bit of a passion project. Obviously, Colombia, Latin America, very challenging business environment there and materially different to the US. But it was a lot of fun. Obviously, I learned a great deal. I executed the transaction to purchase and then also to sell myself. Now, to the latter part, the sale, that actually happened in 2020 during COVID. So needless to say, tourism business in developing country or developing economy did not perform so well in 2020. Unfortunately, I started advertising to sell it on the January 1, 2020. So I got about 3 months into the sale process. I had 2 letters of intent signed to buy the hostel. I probably needed about 6 more weeks before COVID really impacted markets. And for those that remember, COVID became knowable or started to impact financial markets in around March of 2020. So go figure, both the potential buyers just disappeared, no interest there. And effectively then I finally did execute, a sale in September of 2020. But ultimately that was for about 95% less than those letters of intent. So a material decline. Again, I think tourism in a place like Colombia where borders were intensively shut and effectively lockdowns, again, very, very intensive, just destroyed, all tourism, right? So certainly saw the impact of that, finally made an exit because at that point I really wanted to focus on this business that we're talking about today, which I'd set up about 18 months prior, back in my area that I studied and genuine expertise being closer to finance. Mm-hmm. So unfortunately, financially, it didn't end exactly how you would like, but a fantastic experience. And to your point there, Phil, to be able to have that experience, which many of our peers and fellow appraisers, even those that have many, many years more of experience in that industry compared to me, often they've never actually transacted a business themselves. Sometimes they don't know how to do that. They don't know what it feels like to go through that process and really understand, the heavy discounts applied for having a privately held business as opposed to something that is publicly traded. The realities of having a privately held business, let alone trying to transact during a macro event or an industry event such as COVID, which obviously was material for many, many industries. So a fantastic experience, learn a lot, great fun as well. Needless to say, Colombia is a great country as well, and certainly a very interesting time.
Well, that was quite a story, and I admire your pluck in kind of setting out to follow your dreams, follow your passions for that. And Andrew, you have valued so many companies. Are there some techniques that you can provide as advice to our viewers for how do you prepare your company to show itself off, to have the highest realizable value that you can have, with a view towards preparing it, hopefully, for a very successful exit transaction. What are there things that an entrepreneur can do and put in place, well in advance of the decision to exit, that will help them as they're trying to maximize value for the exit?
Certainly. How I like to answer that one is the best way to, and there are some specific factors which we often see across privately held businesses, and I'll touch on them, right? More holistically, however, is that we would then say to a business owner, the best way to get sale ready is either to simply go to market and see the types of questions you get asked, listen to the feedback and understand the negative drivers of value and the positive drivers of value. But if you do that, you'll be showing information externally. There's risk to it, costs a lot of time, a lot of energy. So a better way of doing that is effectively having a test run of due diligence for a potential sale with an independent party who won't disclose your information to anyone. And that's effectively what we've had the valuation process described as. Because when we value a business, we ask all these questions, right? Financial and non-financial, that a sophisticated buyer most probably will ask. So that's one of the greatest bits of feedback I've had from clients, privately held business owners that do the valuation process with us. If they're thinking about making an exit sometime soon in particular, they get to the back end and they go, yeah, there was a little bit of pain in that process. We had to get all our documentation ready and you asked us questions that, we didn't know or we didn't like answering.
Right.
But then they get to the back end and they go, the documentation's all ready. I've already answered all of that. I've understood why the tax return didn't equal the accounting statements. And we got rid of that bookkeeper that you guys realised were not keeping the books in good shape. So by going through the process, it uncovers specific to their business, to your point, Phil, those factors that they can change that will make the business both more valuable, but to your point there as well, more marketable, a more attractive asset to then put on the market for buyers, right? So that's one of the greatest bits of feedback we get around simply doing the valuation process, in particular for business owners that are invested in that process. They're putting time into it, and they'll also be the one that's also heavily leading or participating in the transaction process itself. So using it as a test run for due diligence, if you will. And finally, then, the most common factors that we see that people can change in their business to make it both more valuable and more marketable. Now, ultimately, valuation comes down to three very simple things. It's at evaluation date, at any point in time that we value, it comes down to revenue and expectations of future revenue growth, point number one. Profitability and expectations of future profitability growth or decline, same with revenue. Those two drive cash flow and expectations of future cash flow. Some people get too caught up on what's happened historically. There's an actual transaction. Buyers care about what's going to happen for them in future. So you've got revenue, expectations of future revenue growth, profitability and expectations of changes in future profitability. And then the last point is risk. So those three things for an operational business, they are the drivers of value or the things that will decrease value. Now, there's many, many things that feed those three, obviously. So in terms of implementing things within a business and common things that we see, the most common one with privately held businesses sub $100 million in revenue is very simply messy or incomplete financial statements. If someone's looking at purchasing your business and they can't get high conviction around your numbers being true, fair, and accurate, then obviously that decreases their perception of value of that business because there's more risk and uncertainty. It also makes it less marketable. It's a less attractive asset, all else equal. So there's dual effects there. So just having complete financial statements that make sense and that you can explain and justify and defend. It's one of the many benefits, obviously, of audited financial statements, albeit there is a material cost in doing so. But certainly for business owners, and even for business owners that are looking at transacting, in particular if they're looking at transacting to a financial buyer, such as a private equity fund, right? We really encourage changing, the financials, but this requires implementation or changes to operations and removing as many add backs or personal expenses from the business, in particular in the last 12 months leading into a transaction.
Right.
If you're selling to PE, often they'll be looking at a trailing 12-month, measure of EBITDA or something like that. If it's a high growth tech company, maybe they'll be looking at, a multiple of revenue or some other metric, depending on where they see the value in your business. In any case, cleaner financials that add up and make sense, remove the personal transactions leading into, into that transaction will make the business more marketable and ultimately more valuable as well. So that's certainly a key thing, which is not actually talking about anything around the operation of that specific business or industry, right, Phil? And it's something that often is annoying for business owners. I don't care about my accounting, my books. I know in my head how it's all working, but if you want to sell that right and make it marketable, that has to be in place. And then, of course, you can dig into the many operational things that any specific business can change to make increase revenue growth or increase profit margins or decrease risk. But accounting statements, financials, and simply measuring and managing everything you've got. That's often the number one thing that we work with business owners to make their business more valuable and marketable.
Well, that's certainly good advice. And it's clear that doing some self due diligence before a company wants to be sold is really important in order to identify what you have identified, Andrew, which is what are the questions that a sophisticated buyer is likely to ask, and what answers do we have to those questions? And if we don't have answers to those questions, how can we get the answers to those questions? Well, Andrew, the time has really flown by. I've really appreciated your sharing your expertise on valuations and also the tips on how to increase the value of a company to a perceived acquirer are very valuable to those who invest in, work in privately held companies. So for those of you who have tuned in, I appreciate your tuning in. Please visit our website, CrowleyLawLLC.com. Remember that we're here to help. And Andrew, thank you so much for joining us today.
Thanks, Phil. Thank you very much for having me here. Pleasure chatting, and thank you very much to all you listeners for listening.
You've been tuning into the From Lab to Patient, Garage to Market podcast with your host, Phil Crowley. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, CrowleyLawLLC.com. If you found this information helpful, please subscribe, like, leave a positive review, and share with others.